audible in a proper way?
Yes, ma'am.
Perfect. So I will quickly share my screen and we can start. Let me know once my screen is visible.
Yes, ma'am, it is visible.
As a part of this, if anyone has any questions, Tanish, you pick it up because since my screen would be in share mode, I won't be able to see the comments or the chat
Sure,
windows.
ma'am. Sure,
So
ma'am.
people are requested to put their questions on the chat window. First of all, welcome everyone, and it's great to see you all attending on a Sunday afternoon. So thanks for the same. And the idea of this course or this session more is to help you understand what would be the foundational components of corporate finance. As a topic of corporate finance, it's quite a widespread where even a 3 months detailed course is not enough. However, the idea is to make you at high level recognizable on this topic. Okay. And this is not an exhaustive list of corporate finance. This is considered the list which is from a general corporate finance industry. However, there are other corporate banking products which are part of corporate finance working capital instruments from the bank side. Again, that would involve a deeper sessions on that part. Okay. And we are not involving any statistical tools or data models discussions in this. So our focus is more to understand the uh, core family, what you said, the core family components of corporate finance. Okay. So as we proceed further, the overview mentions about the capital investment. So these are the three pillars of corporate finance. Okay. And it consists of capital investment, capital financing, dividends, and returns of capital. Now, when we know, I assume you all are aware about what do we call as a capital. So, capital is something that an owner infuses in the business as its own capital on which he tracks the business returns and the investments. Okay. So now suppose you are, I will take up a very small example to explain what it means by capital investment. So suppose you have some 200 rupees in your pocket and you can either buy two ice creams out of it, which you can sell at 15% profit, and you can buy another three watermelons, which you can sell at 20% profit. So those are the kind of decisions you take up with your capital, right? So obviously we will say better say 20% profit. So people would prefer watermelon. We are assuming other things aside where we say that there would be some OPEX charges or the cost to maintain an ice cream because the shelf life is not direct. And against that cost, the shelf life for ice cream is say 90 days, whereas the cost to maintain watermelon is low, but shelf life is say 5 days. So those are the kind of further nitty-gritties when a person needs to go when we take certain business decisions to invest money. When we say capital financing, now here in your case, it was you have 200 rupees in your pocket. Suppose you don't have that 200 and you need a financing. So, what would be your sources for financing? Would you pick up a financing from a bank or you will take financing from, say, an equity finance or a debt finance or say raised through debentures or things like that? There are lots of financing instruments as we call in our finance terms, right? Dividends and returns of capital. How do we call it as? So we all know these days in stock market, whatever stocks you are invested in, so you become owner of that percentage of stock, and against that ownership, whenever company finalizes their books of accounts and they find certain profitability, company would wish to give that. as a payback to the share owners, which are called as dividend. Okay. And it can be named as a return on capital. So when we say return on capital, obviously we would be thinking that what would be what would be the comparison of ROI. So it's called as return on investment or return of capital, either of the ways. Okay. Now, who are the major players in the corporate finance? Right? Investment bankers, as we know, bonds or shares, those are the instruments for funding. Then you have capital, and then you have investors. Okay. There can be institutional investors, there can be retail investors who are the buy side of the contracts. And then there are sell side. When we say sell side, it's more around people who need money. So corporation needs money in return of shares or bonds, which goes to the investors, which are retail investors, or HNIs, which are called as a high net worth investors, or the fund managers of various AMCs, which are called institutional investors as well, right? So those are the major players when we talk about corporate finance. Why you need corporate finance? For your working capital, for the business, and things like that, right? So we talked about the players in corporate finance, but those were the primary side of business. When we say primary, so shares and bonds are the direct primary instruments because they are directly dealt in. What are the secondary market? Secondary market can be the market where it's more like a B2B, where it's not directly dealt with. So if you see the difference between the two, here you have corporations in between and investment banks. Here there are two investment banks and they are buying intermittently. So they are dealing in a secondary market. They are not directly going in the primary market to buy that shares from the corporations. They buy from internal IBs, right? It's a huge volume that they deal with day in, day out, right? So there are coupon rates based on which the valuation of the underlying assets, when we call underlying assets, say share of a particular company, which gets traded at certain price in the market, and on top of it, there are certain coupons which would be picked up. So that coupon rates decides the rates of that instrument, and based on the best coupons, the contracts are signed. So as we see capital budgeting, right? So as we went through capital finance and all, so from where does it come? It comes from capital budgeting. Okay. So in your case, the first case that we discussed, it was a 200 buck, which was used either for ice cream or either watermelons, right? So how do you know you need 200, right? So first of all, you will decide what is the business need. Yeah. How much capital is it required? What timelines does the capital is required? And from when that capital will start giving returns, right? And how do we start comparing the profitability index of the deployed capital? Now, discounted cash flows. You all would have known about cash flows. See, I'm trying to go in a certain speed because to cover the major scenarios in 1 hour, I'm trying to touch base the basic concepts, and then we can take a Q&A, or else you can type it in the window, whatever makes you comfortable. So as I'm again assuming you know cash flows. So when we talk about cash flows, It's more about what is the cash in and cash out for a particular period of time for that business entity. Why is it, what is it different than balance sheet P&L, and why is it important? So any entity carries the risk of cash to maintain the day-to-day operations. So cash flow, it really helps an entity to define what would be their immediate liability or obligation, which would be honored with the available cash balance. Now, there can be scenarios where a business would receive, say, 1,000 million today out of a certain transaction, or a business would receive 1,500 million, say, after a week. How do you define or how do you compare that 1,000 million today with that 1,500 that you receive after, say, 5 days? So that's T plus 5, right? It's non-comparable. One is 1,000, another is 1,500, and anybody would say, oh, it's better, 1,500 is there, so we would always try to take money after, say, 5 days. However, if you discount that cash flow to the current price using the net present value, using the current inflation index, current interest, and the value that you derive, that 1,500 might be 900 as of today's value, or it can be 1,100 based on the market rates and inflationary trends, right? There is a formula to define your discounting of your cash flow, right? So that gives you apple to apple comparison on how a particular business can take a decision whether they need a cash flow today or say after a week. So what we talked or what we did was a discounting of the future cash flows. Now, when we talk about net present value, right? So it's considered as, it's an extension of cash inflow outflow. But as we see, it's again factoring whatever amount you get with the net present value or the factor, NPV factor. There's a formula to define an NPV factor. And once you define that NPV factor, you get a value, which is your NPV or the present value. Then you can compare it with your current amount, and that gives you the decision. Payback period. Now, what happens? Suppose you invested in an ice cream or a watermelon business. Say you invested 200 million in an ice cream business as an inventory, not 200 rupees. We take 200 million, right? So you would have taken an X inventory of ice creams, and similarly, you would have taken a watermelon, right? Now, what happens? That ice creams, once that inventory is sold off in the market, the cash flow inflow is generated, then you realize the profitability of the same, right? So the time to start realizing the profitability from the cash flow defines very well as to what is your payback period to generate enough cash flow. All right? That's a basic parameter to define the investment risk, right? It involves various costs in terms of what would be your initial cost of setup, what would be your capex, what would be your opex, whether you need to define capex here, and what would be the shelf life, what would be the nominal loss. There are many other factors, and then you go further, right? Then you have something like profitability index, right? Now, how do you define whether the profitability of watermelon business or profitability of ice cream business is good? And irrespective of this, based on your industry sector, what would be the better profitability index and how much is your profitability index? Suppose your ice cream profitability index is say 12%, and your watermelon is say 15%. Now you go and compare the industry benchmark in say frozen desserts industry, right? And their profitability index is say 13% or 15%. So that time you will realize that your 10% is lower. So that even helps you measure the efficiencies of the business, whether you are running an efficient business or not, right? Or you define something like in a farm business, watermelon is giving you 15%. Say if you do certain business of certain vegetable, like say spinach would give you 50% profitability. Bananas might give you 20%, right? Then again, the discussion comes on the shelf life and other discussions, factors or parameters. And then you decide that no, it's better to go with which product. So that's how all of this KPIs or all of these values helps you to define your basic thing around capital finance, or where to invest your capital, which you can do, right? Then it comes to the capital structure. So when we talk about capital structure, so how does this minimize the weighted average cost of capital and maximize the shareholder value, right? So when we say optimal capital structure is the weighted average cost of your capital and the optimized return on capital to shareholders is the optimal structure. Obviously, life is not great always, and economies are not as clear and black and white as we speak. So, to define an optimal structure is always a challenge for any CEOs or CFOs, right? Then there are certain models that is being defined. Now, what happens? There are risks associated with any of the capital structure or any of the instruments that you define. Now, that risk comes with certain premium or certain returns as well. That's where we say higher the risk, higher the return, right? So there are certain models which have been defined to identify the right asset pricing models. One of those is CAPM, right? Which considers the factors like market risk, it considers the factors like risk beta or the premium or the systematic risk as we call, right? So it's very important to analyze or have the lens. So all this I'm giving you a high level. You can go and Google, and there are very good materials available for you to deep dive and understand it further. Weighted average cost of capital, right? The return of a company which they pay back to the shareholders, weighted by the proportion of each financing score, right? So what happens? We saw that how much percentage does the shareholder get, right? Against that, how much percentage cost did the company pay to have that capital, right? Say dividend cost or other charges or things like that, right? So when that all gets factored, you get a weighted average cost of capital, which is very important parameter again. Okay. Then you have something like debt versus equity financing. So debt, as we saw, bonds, debentures. So when a company puts a debt, there's a different coupons, right? Interest rates, fixed interest rates, irrespective of company doing a profitable business or not. Company needs to pay that interest and that premium to the investors, maybe the bond investors and things like that, right? Whereas in equity, as we saw dividend, in equity, what happens? Based on the business of the company, based on the profitability of the company, there are dividends which are declared. So debt is a liability to the company, which is a fixed liability. However, it doesn't dilute the capital of the company. So it's very important to have this mix of a good liability versus good cost of capital, right? Whereas when they talk about equity, they need to liquidate their ownership, the shareholder capital and holding, right? Dividend policy. So, based on many of these factors, once the company during the end of their finance or their balance sheets, they decide they need to declare certain money as a dividend, right? So, companies define that whether they want to plow back certain profits back to their business, whether they need to use that profit in some other work, or they can try to define a dividend. Now, in a certain year, company is doing very good and they feel that they will be giving some 50% dividend. Next year, say for any reason, XYZ in the economy, company is doing bad and they're not even able to give 5% of dividend. So dividend policy tries to define and gets the delta of highest and lowest and B median, which is B nearby of what uh company has already given, right? From last 3 years or last 5 years or last 10 years. So as per that, then they define the percentage, which is ideally should be there. They try to work around that. And that's how they define the dividend policy to keep the dividend consistent year on year, which is very stringent. Okay. And next, now we are coming to working capital management. So it ensures that company can meet its short-term capital obligations and operate efficiently. Now, say in the same example of ice cream industry, right? Your working capital would be what? The cost of ice cream, cost of procurement of ice cream, cost of keeping that cold storage active, cost of keeping the logistics active, right? Now, what happens is daily there would be cycle of cash outflow that will go, certain expenditure that has to be done, right? And there can be also a scenario where that ice cream is sold on a daily basis and there is certain cash which is coming. That's where there is a term they say cash rich business because the transaction happens in cash. So most of the food industries are considered to be cash rich because the cash conversion cycle is quite high and fast than any other business. Like unlike say a capital engineering equipment business where cash conversion cycle is say 6 months because from the time the raw material to the end product gets supplied and the liability to get the final cash or check is there, right? So that's the cycle it takes from initiations to sales and how it can be then used as one of the parameter. Cash flow forecasting. It's a very good tool to identify cash inflow, cash outflow, and then forecast. So why is it important cash flow forecasting? Now, suppose if we don't forecast cash flow properly, if there is an idle cash sitting with you and there is no immediate obligation, so as a banker or as a CFO, you will be losing that interest. It's like an opportunity cost which is lost because you couldn't invest that money which you need after say 5 days or say after 7 days, right? It also outlines the liquidity parameters of the firm in which the organization works. Then you have something like inventory management, which says managing the stock level. So now in our example, it comes like managing the stock level of ice creams, managing the stock level of which beauty products, which parcels, things like that, right? So then they would say, why? We don't even need inventory. We will work with just in case. That's like just in time inventory. So when we say just in time, it is people have this, it's a Kaizen principle of Japan where they say just in time. However, people are very finicky about this, right? When anybody wants to go early or where anybody wants to see the books of account on their own, they would not be recommending this kind of model, right? Then you have got something like receivables management. So, what do we call receivables? Say, for example, I have sold you goods. Now you are going to pay me, say, after 5 days. So, receivable management has to work closely with cash flow forecasting because receivable financing would say what amount of cash you are receiving, say, after T plus 8 days, transaction plus 8 or transaction plus 10, right? You guys are with me till now, right?
Yes, ma'am.
Okay, thanks. So now with receivable management, we have payable management. If we have something to receive, we have something to pay as a liability also, right? So how does the payable management work? We shouldn't be working where we spoil the supplier engagement, right? That becomes an important part of any working capital analysis. Receivable finance and working capital finance are known as POBO and COBO. Okay, we'll go next. Till now, these were the foundational topics. I hope you are okay before I move to advanced or any questions now.
If anyone has any questions, they can drop them in the chat box or they can raise their hands. I guess we can continue, ma'am. If
Okay.
anyone has any question, they'll ask in the end.
Okay. So now advanced topics are mergers and acquisitions, right? What happens? We hear a lot about Vodafone Idea deal. What was it? It's a merger. Why do company go for it? Because at times now mergers can be an hostile merger or a friendly merger or things like that. We see at times that RBI or SBI funds certain banks, right? Like I don't know whether you were aware about the scenario of Global Trust Bank and Barclays and things like that, right? So those are the kind of a merger which which was not even a planned merger, but it was because of the economic situation of that particular entity, right? So it can be an hostile merger, it can be a friendly merger, it can be things like that. Now, when we talk about merger valuation, So how do you value that? We spoke about ice creams and watermelons, but when we talk about 2 million transactions or a 2 million value of a company, how do you define that value, whether it's a right value? Now, we hear a lot of people in Shark Tank saying somebody who is running a startup company 5 years, 10 years, they say, oh, you know what, give us this. And immediately you will hear the Shark Tanks calculating and they say your valuation is not right, right? So, what does it mean? It means based on your profitability, based on your sales and revenue, based on your discounted cash flows, what is the value that they can put based on the numbers, right? So, those are the kind of decisions they take on the brink, but they don't give a check unless actual check, unless they they do their due diligence, right? So after the sessions, there are lots of due diligence happens on the financials of their business, and then the right valuation is decided, and then the right funding is being paid. Now we are hearing about Vodafone and Idea deal. How does it happen? What will happen post merger? Because you are going to merge your customers, you are going to merge your operations, you are going to merge your businesses in a way where it looks one. It's not an easy affair. Your company books gets rewritten, your balance sheet looks different, right? So there are cultural differences when your employees start working in a say, different entity. There's lots of change management that has to be taken over, right? However, there are lots of synergies and cost savings. Now think of it. We see this all the financial institutions, NBFCs and all, they have made their support staff central rather than the cloud kitchen kind, right? What's the reason for that? It is because you also bring efficiencies of scale, right? In economics, we hear economies of scale, right? So same logic applies here. If you run a particular operation, say for once, the cost of running that operation would be higher. We always see the retail rates and the wholesale rates. What's the difference there? It's the economies of scale. So similarly, when two organizations or the two entities are merged, you get lots of synergies and cost of savings. That's the biggest reasons of the mergers. Okay? It looks very fancy. Everyone would say, oh, we need to do mergers, we need to do acquisitions. However, there's lots of precautions that has to be taken care so that brands don't change their identity or the customer experience doesn't get impacted. That's a key value. Now we see this topic of risk management. There are various kind of risk that we speak around. That's financial risk, hedging technique, operational risk, value at risk, credit risk. Financial risk, very, very direct example as we call. So any CFO handling the treasury business, right? They're always worried that today, if my account says I have $1,000, and today the value of dollar is say 82, and tomorrow dollar and I fluctuates and say it becomes 92. So the same 1,000 USD, which was costing you, which was coming in your books in INR at 8,200, would be coming at 9,200. So if you had receivables of 1,000, then say if it is coming by 9,200, you gain it. But suppose if it is your payable, then you lose it. So depends on what position you are. Are you long or are you short in your position, right? So market volatility, at times certain currency drastically, falls in their price. So what happens, right? Then there are certain hedging techniques. So how do you hedge? There are lots of models like Black-Scholes models. We call it as BSM model to calculate the cost of capitals. And then there is a technique of butterfly, or you make a reverse hedge. You do short of, you know, same directional of options. So in simple terms, hedging is, suppose tomorrow I see that USD INR is going to increase. I will be taking an option. So suppose the current market value of USD INR pair is 82. I predict that after a week, it would be say 85, right? So there is certain premium which is being calculated, which is called as a cost of option using BSM model, or there are various other models also. Black-Scholes is the commonly used.
Sorry to
So
disturb you, ma'am.
yeah,
Rahul in chat has asked if you could explain a bit about what is hedge.
yeah. That's what I'm trying to tell you now. So your 82 current trading of your USD INR, if you predict that it would be 85, then you are doing a forward cover. So you are covering your risk. So we assume that you are required to pay 1,000 USD at 82 to say Mr. X in USA, say on 28th of December. Now you feel that because of market demands of more USD during holidays, it will go up to 85. So your liability of payment of 82 into 1,000, which was 82,000, will move to 85,000. So you need to cover for the 3,000 additional hedge, right? Because your liability is in USD, not INR here. And market between USD and INR is fluctuating. So to cover yourself, you will take an 85, the premium of option for 85 strike price. 82 is a strike price, which is a current market price. 85 is a strike price after a strike price for 20th December. And obviously, because there is a probability, there is a time factor of say 10 days plus a premium amount, because there is a probability that it may go to 85 or it may not. Price of that premium is say 1 rupee. So you would prefer taking that 1 rupee cover for your 85 liability for 1,000 USD. So you will take it at 1,000. So additional cost was 1,000 to buy that premium or that buy that option. the future cover, right? So now on day of 20th December, suppose you actually got the market at 85. So your liability is 8,500, which was originally 8,200. So you are supposed to pay 3,000 extra. But because you had covered yourself with a cover of 1 rupee premium, you have that cover to take care, and you can still take that 85 rupees, 85 at the price of 85, that $1,000 at the price of 8,500. So you saved your 2,000 rupees here, right? So your cost is 8,200 plus 1,000 as a premium that you paid for that option. Now, based on the different directions, this may be up or this may be down. Okay. Rahul, does it answer your question now? We hedged over 3,000 of loss with paying that 1,000 rupees extra. Okay. I assume that you got it. Then we have value at risk.
The contents have been updated. To review the updated items on your screen.
Sorry, my B also wanted to speak something. Sorry. So then we go to value at risk. So value at risk over here, in terms of you have an overall 1 million, right? What will happen to your asset? You can't always predict that your 1 million will always increase by 8%, 10%. There may be a scenario where 1 million can become your 0.5 million also. So there are different market deltas. That deltas are called as a risk. They are different multipliers like standard deviations, how much your theta deviates from the standard median. And based on that, you get a coefficient correlations. And that's where you define the value at risk. Right? Then you have something like credit risk. So what US 64 disaster. So that was a plan where there were lots of people like, hello, am I audible?
Yes, ma'am.
Yeah, I don't know the screen. And okay. So what was the case where UPI generally came up and took money from people? It was a bond, and they said that we will honor this bond with say 12% coupons after 5 years, 10 years. But for some reason, they couldn't pay back the principal amount as well. And as a part of it, it was a failure. And because of which, then that was the time where mutual fund industry entered the Indian markets. And people started, because it was governed by SEBI, it's governed by proper fund managers, and there's lots of pillars of governance as a mechanism between SEBI, AMCs, and investors, where the credit risk is quite low, and hence people started putting money there and not the bonds kind of thing of US 64. Now, suppose you have two friends and one of them does not pay back the money, the credit rating of that person goes down, right? Similarly, your CIBIL scores provides your credit ratings. Same way, there are CRISIL scores which provide credit ratings for the organizations, right? Then there is something like operational risk. So operational risk over here covers the risk while we operate in the economy. So for example, in our original case of ice cream and watermelons, what happens while transporting those ice creams in a frozen containers? The refrigeration for some reason malfunctions. And by the time ice cream reaches the stockist, it's all in diluted form. It's a total loss of the product, right? So that's an operational risk. Similarly, cyber attacks, where recently we saw in Australia, UK, and all the airlines were shut down because there was a screen, black screen, and literally people were not able to do their transactions, right? So that's loss of business. So that's an operational risk. So with this, I will check with Tanish on the timelines we give it for Q&A, or how do we want to go?
Yes, ma'am. Let me ask the audience if they have any questions. They can drop them in the chat box or they can raise their hands. We'll make sure to address as many as we can.
Sure. I hope you got some of the idea of the topics that we covered today.
Yes, ma'am. It was like a great session. Got to learn so much about corporate finance. Just a new topic for many engineering and management students. Guys, if you have any question, you can drop them in the chat or raise your hands. Not have much time left. I guess we can conclude the session if no one has any question. Sure. Thank you, ma'am. We appreciate you taking out your valuable time to teach us. Shah as
Always
well.
a pleasure.
Uh, uh, we have got a question from Anisha. She asked from where she can learn more basics. If you can suggest some resources or something.
There is this curriculum from CFI, Corporate Finance Institute. And even if you go in, if you don't want to invest so much and all, you can go for this Udemy. Udemy also have lots of sessions on corporate finance. It's a big wide topic, so it all depends
Yes.
on what part of corporate finance you want to go deeper. But basic finance terms that we discuss in the foundation area, you need to pick up at least and to understand that.
Okay, ma'am. I guess that answered your question. Uh, okay. A big thank you to all the participants as well. Uh, with that, we'll conclude this session. Thank you, ma'am.
Thank you. Thank you. Have a great time. Bye.
Thank you once again. We look forward to have you in next sessions.